Okay, guys. Hey, this is Bryan Loewen, Executive Managing Director with Newmark Knight Frank, their data center practice. I've known Bryan for a long time, and I'm really excited to get to hear from you. And so Bryan's got some great perspective on different industry vertical companies and what they're doing. And so one of the reasons that I wanted to get together with Bryan was just to hear about how different companies are looking at their data center IT infrastructure requirements. And so it's fun to sit down with someone that's talking with those companies and really helping them determine what's the best strategy for the needs that they have. So Bryan, thanks for being here. Excited. Let's start with the change of, and maybe this is just the maturity of the industry, but maybe talk users as a whole. So we're going to talk about healthcare companies, cloud providers, financial companies, technology companies, but just talk about how you've seen the data center market change from a user perspective over the last 5 years.
Yeah, so the last 5 years, we've seen tremendous change in the industry. And I think a lot of it's been driven through the efficiencies that a lot of the hyperscale companies have kind of brought to the marketplace. So we're seeing, you mentioned like cloud operators and stuff. The scale that they're building out at has really challenged the overall data center industry to become more efficient, not just operationally, but from a construction design and overall cost.
I agree. Is that a challenge for companies? I mean, the way that you've seen both data center operators, but also companies themselves having to look at their infrastructure, look at the way they have deployed it. It might be in multiple locations. It might be with multiple applications in certain areas. Like, is that hard for them to do traditionally?
Yeah, it's very hard for the enterprise to do. So I think the enterprise companies they're the laggards in the industry as far as, they're not the ones creating the change. And when I got in this industry, it's probably been 15 years ago, we kind of saw the same thing where the enterprise corporations were very slow to even adopt third-party colocation. Now you're starting to see the adoption is there, and people fully believe that it's better to utilize third-party resources for their data center sites versus building it themselves. In the last 5 years, though, we've started seeing the hyperscale requirements create a lot more efficiency. So 10 years ago, Uptime Institute published reports that talked about tiering and what the cost was to build certain tier stuff. And you probably remember these, that there were guidelines of $20 to $25 million per megawatt to build out a tier 3 data center site. Now, we're hearing things on Wall Street where the analysts are asking the publicly traded REITs, how much does it cost for you to build these data centers? And their answers are typically trying to push downwards. They're trying to get below $6 million a megawatt in some situations. So that scale has allowed for the efficiencies to play out to the rest of the industry. And enterprise, financial, healthcare, these different verticals are taking advantage of the efficiency that the overall has been driven into the industry.
Yeah, I think you're definitely, I mean, you mentioned it, but the data center publicly traded companies really pushing hard to drive that number down. And those companies, the providers that can deliver both from a cost-effective perspective, but also from a speed-to-market standpoint, have a lot to gain as it relates to large hyperscale cloud requirements. Talk about the financial industry and how you've seen those requirements change over the last 3 to 5 years. Traditionally, companies that have high needs as it relates to their infrastructure redundancies, typically 2 in at the UPS system, sometimes even at the generator systems and cooling. But how have you seen that change?
So I think the financial industry, for the most part, has still kept to that high resiliency, low latency type of standard design. We are seeing a shift in the workload. So there's a lot of the production workloads that they can push out to either a cloud operator or to a less resilient kind of data center footprint. But the core of what is mission critical to their business is still that typical 2N design, low latency, a lot of fiber redundancy. Lots of redundancy is really built into the data center site. So that DNA is still in place with the financial service industry, although I think they've evolved in the last several years to start pushing some of that workload to maybe more cost-effective locations than putting everything in downtown New York City or in New Jersey or someplace that's very costly.
Yeah. When you think about industries that are traditionally behind the curve of not only taking their IT infrastructure to like a co-location facility, but maybe it's even from a cloud standpoint. Where do you see that today, and what industries are behind as it relates to adopting third-party data center services?
Really overall, the enterprise industry, with the Fortune 5,000 type companies that are in the data center space right now, I still see a lot of inefficiency in their design. So they have it's not a homogeneous design, which is very difficult to do for anybody except for maybe the hyperscale cloud operators or somebody of that scale. But they have a lot of low density applications. They have a few high density applications. There are some facilities that have older equipment and older infrastructure in place, and they're mixing all these things together in a manner that is not really competitive in today's overall marketplace, but it's still pulled together. So when I walk into a corporate data center, I will tell you 8 out of 10 times, even today, I walk in, I don't see the same level of infrastructure and improvements and efficiency that you see in the data centers that make the news that you and I talk about every day.
Yeah, interesting. And if you think about the way connectivity has changed, talk about that as it relates to these companies. And do you find these companies are becoming more or less find their connectivity more or less important?
Connectivity is absolutely a backbone of almost every data center operation. So the more connectivity, oftentimes the better, especially from a pricing and price leverage perspective. So when we see things like the Infomart here in Dallas trading at an all-time high multiples, the reason is the ecosystem that's in place from a telecom perspective. It is not the data center DNA that defined that building. It was the telecom that defined it. In the enterprise data center, we do find that you don't need 10 different telco operators coming into a site. And oftentimes these companies have existing relationships with the national fiber providers that will allow for them to kind of bring the telecom infrastructure into the data center. But the cost is probably the biggest issue. So if you only have 1 or 2 providers in your data center site, it's very difficult to really leverage pricing and price points, especially for smaller corporate users.
Yeah, well, that's interesting, talking about the deal drivers and what's really driving, decision making from IT organizations for companies. You're at the tip of the spear, so you're talking with those companies, you're meeting with them, helping them formulate a strategy with their IT infrastructure requirement. What are some other drivers as far as what is pushing them to make decisions? Is it more related around connectivity? Is it around total power need? Is it around hazard risk? Where are you seeing those drivers change?
Yeah, so the hazard risk piece, I'll just hit that first. I have seen less of that in the last 5 years than I saw in the previous decade. So the hazard risk aspect of it, about the worrying about being inside of a flight path, or certain areas that were 1 in 5,000 year kind of risk assessments have kind of gone wayside a little bit. I think one of the biggest things that have come in place in the last several years has been the regulatory framework. So we are constantly being asked, if it's a healthcare provider, there's HIPAA and high-tech requirements. If it's financial services or credit card related, the PCI DSS requirements. SOC 1, SOC 2, FedRAMP, even LEED certifications and other things like that. These type of regulatory framework items are a gating factor for many of the companies that are seeking data center requirements. So on that front side of that spear we're talking about, the gate doesn't even open if you don't meet certain requirements. And it's not the 500-year floodplain or the risk assessments are important, and but they oftentimes are saying, if you don't have the compliance that we need in place, it's not even an opportunity for you.
And I think a lot of the hazard risk stuff today is actually assumed. I think that people have gotten comfortable. There are some areas, highly developed areas in the United States, that are right in the middle of a flight path. Just based on the way that really infrastructure from a power and connectivity standpoint sits. And so I think there's certain things that companies have gotten comfortable with, but you're right. Compliance is front and center as far as how companies have to direct their infrastructure requirements, where they go, who they partner with. And it's one of the, I would say, ways that the data center provider industry has gotten better over the last 5 years from a maturity standpoint. If you think about when this industry really started, data center operators were taking buildings with abandoned infrastructure and basically putting them back together and putting tenants in them. And then over time, it got more efficient. They understood how to build more efficiently and cost effectively. Then they began actually, tearing down buildings and building them from the ground up. And then there became this maturity of services. I think the data center operator community and the way they've matured in that area has really benefited the end users. I'm sure there's still opportunities for them to grow, but I do think that has changed the way that a company can now look at a data center operator and think, I'm going to be in this facility for the next 5 to 10 years, and I need to make sure that their compliance is what it is today, but they'll meet the compliances that I might need tomorrow.
Absolutely agree. And I think the second factor behind that still comes back to total cost of operations.
Okay.
So a TCO, total cost of operations analysis, is always done amongst a finalist set of, once you've pre-qualified that gating factor, you're still looking at energy costs are still very important. Any sort of, especially if you're looking on a regional basis versus a single market basis, the telecom costs come into play, the operational efficiency of the data center, meaning its PUE or power utilization effectiveness comes into play. So all of these factors, on top of the rent, are very important to the site selection process. And those were important years ago, but I think they've matured in the last several years, and the analysis and the ability to have access to really smart resources that understand what it is to lease a data center space or buy a data center, and how do you buy it most efficiently. That wasn't really in the play. We had a lot more volatility in the marketplace even 5 years ago.
Yeah.
And I think still people fail to realize how new this industry is.
Yeah.
This industry, we still see a lot of volatility compared to healthcare industry or the office or industrial space. I mean, those industries have really very low volatility compared to the data center space. I still see, even to this day, less volatility than 5 years ago, but still more than the other real estate sectors.
Yeah, from a commercial real estate perspective, those that look at it from that side of things, it is a relatively young industry. I mean, you're right. And, it can be even hard for commercial real estate companies to understand the opportunity. Number one, because we're talking about power, not square footage. Number two, because it is a smaller subset, but the capital investment is so large. I mean, you mentioned, the Infomart selling in Dallas, last week, I think it was for $800 million around there. So obviously every data center doesn't sell for that much, but that's a really good example of the value that these buildings from a real estate side of things hold. Let me ask you about healthcare. From a healthcare perspective, talk about, if you're talking to a healthcare company, what would you want them to hear about their IT infrastructure and potentially, what they need to think about as they look at kind of this new era of hybrid, cloud and co-location put together?
Yeah, so we are working with a handful of healthcare companies, and I will tell you a couple things that jump out. One, they're always asking about compliance. I would say the HIPAA and high-tech compliance factor is becoming the new it's the new norm for the questions coming in. So basically, you have to have that sort of compliance for them to feel comfortable in your data center site. But what I'm seeing, healthcare companies, they're still, they want that 2N infrastructure. They want the high resiliency cooling infrastructure. They're still very reliant on basically having a 100% uptime kind of situation. So unlike the hyperscale stuff that we're seeing built with the large wholesale operators, oftentimes those designs are 4N/3 UPS system. That really isn't that's kind of scares away the healthcare companies a little bit.
Yeah.
So I think they're still they're probably where the enterprise companies were 10 years ago in the space.
Yep.
So they're kind of the laggards in the space as far as entering, but we are seeing a lot more healthcare requirements being shifted from the actual hospitals or the on-site healthcare site to a third-party co-location. And over the next 5 years, I think it's going to even increase a lot more because we're starting to just now get through that initial phase where you're seeing a handful of these companies do it, and this makes sense.
Yeah.
I'm going to do it as well because my counterpart CIO decided to move his offsite, and they've cut their operating costs. So you're seeing that kind of propagate through the industry.
Yeah. If you were to talk to companies as a whole, and you were to say, this is how we've seen companies make the best decision as it relates to their IT infrastructure, for a 3-year, 5-year, 10-year period, what would you say? And the caveat to that is, most companies, when you make your decision today, the reality is that you were basing it on factors you were probably looking at 6 months ago, maybe even 12 months ago. So a lot of times the day that you make the decision, the market has moved on, and there's new technology, there's new products. So what do you say to someone knowing that the future is going to change and it could impact, the decision that they make today?
I think third-party sites make sense because what we've seen in the industry is that as it's evolved, you're seeing shorter terms, more options, and a lot different. A lot of things like portability that were never even accounted for a couple of years back. You can ask for these as a tenant and say, Mr. Landlord, I would like to get, and basically give them your wish list. And, I came from a very old background in commodity trading many years ago. And, the big thing on the commodity trading was options and optionality. So I think having options and optionality is very important for tenants. And if they're asking for those options, more times than not, the landlords these days are accustomed to giving them options. And I think that's the way you protect your long-term vision in a site, because we all know it's very difficult to pick up and move a data center. However, what the data center footprint looks like 5 years, 10 years from now, it's a magic box. Nobody knows.
Yeah, you bet. Let's talk about the U.S. and where you think the most growth will take place in 2018 from a supply and demand perspective.
Well, the easy answer is Northern Virginia.
Sure.
So I think Northern Virginia has a competitive advantage at this point where they're just seeing scale that no other market in the North American, really in the global markets, is really seeing. So I think that's
I always feel weird saying that, like in the world, but it really is. I mean, there's no other place really in the world that has the type of scale that market has, So I agree with you. It's always like I'm talking about the U.S. but it is really one of the largest areas in the world that from a supply perspective.
Absolutely amazing. Just seeing the growth there. It actually outpaced what I would project almost every year. I still, it's hard to fathom how much capacity is being added in that marketplace. And the amount of new capacity that we're projecting to come on in 2018, 2019, and 2020.
Yeah.
So I think that marketplace is going to do very well. But, outside of the absolutely very obvious statement, we are still seeing the Chicago, Dallas, and Silicon Valley markets tracking very nicely from a growth perspective as far as the big markets.
Yeah.
Atlanta and Phoenix and the Pacific Northwest are all growing quite quickly compared to what we've seen in historically. But I think the big markets are still going to get considerably bigger than others, and you'll start seeing. We used to always talk 5-10 years ago about New York, New Jersey being a very large marketplace, and it is still from a supply perspective one of the largest markets in the world. However, the growth there has really been limited compared to what we saw 5-10 years ago.
Yeah, and I think I think that highlights two things. One is that significant growth from a power perspective really looks at the cost of that growth, and will go to places where there's more economies of scale as it relates to power cost, rental rates, et cetera. So they're really looking at their overall perspective and how they're going to grow, and so that's where you've seen that large demand go. I look at New York, New Jersey, Boston. The Northeast is really a strategic location as it relates to data center infrastructure requirement. That if you're there, it's because it's a strategic location for your company, for a project, an IT project that a company is working on, and you'll pay the higher rate because you need it to be in that geography. I mean, that's really what I've characterized kind of that Northeast sector as being. Talk about what you're most excited about when you think about the next 5 years in this industry? You mentioned, I mean, the industry is relatively young, but talk about, your thoughts on how it will grow and what you're most excited about.
I think there's two things I'm very excited about the industry. One, I think the cloud growth is going to be phenomenal.
Yeah.
And I'm really encouraging my team and the people that we work inside of Newmark to start asking their clients questions about cloud growth. And the word cloud it's the most broad term in the industry. However, there's so much service going to the software as a service and infrastructure as a service. The opportunities in the next 5 years are second to none that I've seen in the industry. It really reminds me of the early days of wholesale colocation. I mean, when I got in 2004, it was the wild, wild west in the data center space. Cloud service offerings are there right now.
Yeah.
So we are at the precipice of a humongous amount of cloud growth in the space, and I think it's going to be interesting to be as an advisor to companies buying cloud space, and also as just a outsider looking at the industry and seeing how it shapes the industry in the next 5 years. The second thing that I think we're going to start seeing a lot more in the space, or the change, is really the financial services side of the business. So the debt and the equity coming into the sector after having so many years, we've had 10 plus years of tremendous growth in the data center space. The investment communities are looking at this sector now as a entry place for putting more and more of their funds. So we're seeing a lot more competitive terms for equity and debt coming in the space outside of the public market. So there's obviously 6 firms that have taken advantage of the public markets, but a lot of the private money that's coming into the space is really pushing, trying to get into this space, and it's created an opportunity, quite candidly, for a more efficient data center to be built over the next 5 years than what it has been, historically over the last 10 years.
Yeah, and I think too, it's really interesting how the publicly traded companies and the privately owned data center operators compete against one another. I mean, the privately owned companies are very competitive in what they're putting out in the market today, and their iterations of their product, I think, has gotten a lot better over time. So, if they're smaller IT requirements or larger IT requirements, traditionally you have both groups bidding on those type of requirements, and I think that maturity is only adding to the growth that's taking place today.
Absolutely, it's adding to it, and you're starting to see the cap rate compression, other things that come into space that we have seen already in the office market, the industrial market, more mature commercial real estate markets. You're starting to see those come into the commercial data center marketplace. And I think that's a change that really a lot of people hadn't seen over the last decade.
How many companies that you all work with have international requirements? How many companies are you talking to that say, hey, we've got our U.S. strategy under wraps, but we need to look at Europe, or we need to look at in Asia? How many companies are you having that conversation with?
I don't know the quantity, but I will tell you, on our global corporate services platform, of the accounts that we manage, I would probably say 70% have a global footprint.
Yeah.
And
interesting.
Of the 70% with a global footprint, 100% of those are pretty darn close, are having some sort of IT discussions globally. It's not a North American-based decision, or not just a North American-based platform. So the requirements and regulations that are in place in various countries require proximity in those countries. Some of the data has to stay in those countries, and we're seeing that change the industry right now.
Yep.
We're also seeing that the reliance and dependence on technology is so inherent in our corporate business and DNA these days that if you don't have the right infrastructure in place, your business can fall behind and even be go out of business. I mean, so the reliance on the IT platform is nothing unlike it's been really in history, and I think you're going to see more and more reliance and dependence on the IT business.
Yeah, it is a fascinating industry to be part of. I was telling somebody the other day, if you had told me back in 2014, 2015 that the last 3 years we would see the growth that we have, I don't know if I would have believed them. So it's been amazing to watch. I think people that are sitting in your position, that are talking with companies, that are really trying to understand what their needs are and how the market best meets them. it's a really interesting story to tell, and I think a couple of years from now, just being able to go through this process over the last however many years and talk about how the market was originally to where it is today is really fascinating, because it has changed so much, just the initial requirements that companies had 10 years ago and how they look today.
It has changed a lot. And we're going to continue to see technology improvements.
Yeah.
Really the data center that's there today, a lot of it was the same data center we saw 10 years ago. We're working on a equity raise for a private company that actually has what we would consider a disruptive server technology. The server itself can replicate, the standard x86 servers that are prevalent throughout the rest of the world, and it consumes about 1/20th of the energy of a regular server.
Yeah.
That's a major disruptive change, and people often think, well, what's this going to do to the data center industry? You can now fit everything into the size of this, cup. Everything magically can shrink down into one little space. But what we tend to find is that as consumers, once we make those changes, we find ways to utilize it and to market it. So as we grow and become more efficient, it's not going to be too long before my daughter has a server in her pocket, and the power of a server in her pocket. And when you start looking at what other technologies can be built on that, those technologies are all housed in data centers. And I think that's where the next 5 years is going, is that we're seeing technology changes and the efficiency in this marketplace drive other technologies.
Yeah. Well, Bryan, thanks for being here. This is really fun.
Absolutely.
Love getting to be with you. If you want to learn more about Bryan's practice, you can go to datacenterconsulting.com. And if you want to learn more about datacenterHawk, it's just datacenterHawk.com. Thanks for watching. We good?
Yeah.
Okay.
There it is.